The average investor is asking, crypto or stocks? It's a question with no easy answer, especially in 2024. But we're going to cut through the noise and give you the information you need to make a smart decision. We're breaking down the current state of crypto versus stocks. Where are we now, and what are the best moves for your money in 2024? Foundational differences. When considering where to put your money, understanding the fundamental differences between cryptocurrencies and stocks is essential. Cryptocurrencies like Bitcoin and Ethereum are digital assets that use blockchain technology to ensure secure and transparent transactions. They are not tied to any physical asset or central authority, making them a unique and innovative form of investment. Stocks, on the other hand, represent ownership in a company. When you purchase a stock, you are buying a small part of that company, giving you a stake in its profits and losses. Trading mechanisms for these two investment types are quite distinct. Cryptocurrencies are traded 24 hours a day, 7 days a week on global online platforms. This round-the-clock trading allows for flexibility but also means that the market is always moving, potentially impacting prices at any time. In contrast, stock trading is confined to specific hours on regulated exchanges, such as the New York Stock Exchange or NASDAQ. These exchanges operate on a set schedule, typically from 9:30 a.m. to 4:00 p.m. Eastern Time, Monday through Friday. This structure provides a more predictable trading environment but limits the trading hours. Liquidity and volatility are crucial factors to consider. Cryptocurrencies are known for their high volatility, with prices that can fluctuate wildly within short periods. This volatility often leads to high liquidity, meaning you can buy or sell your assets relatively quickly. On the other hand, stocks tend to be more stable with less dramatic price swings. Their patterns are generally more predictable, and they often follow the company's performance and broader economic trends. While stocks offer a steadier investment with known patterns, cryptocurrencies provide a high-risk, high-reward scenario that can attract those willing to endure the market's unpredictable nature. Historical performance. The stock market's history reveals a pattern of steady growth punctuated by occasional downturns. Over the long term, stocks have generally trended upwards, though not without significant fluctuations. Major indices such as the S&P 500 and the Dow Jones Industrial Average highlight this trend. The S&P 500, which includes 500 of the largest U.S. companies, has shown consistent growth over decades, despite experiencing sharp declines during economic recessions. Similarly, the Dow Jones, featuring 30 prominent companies, reflects a long-term upward trajectory with its own periods of volatility. In stark contrast, the history of cryptocurrencies is defined by extreme volatility and rapid growth. Bitcoin, the most well-known cryptocurrency, has seen its price soar from just a few cents to tens of thousands of dollars. This dramatic rise, accompanied by equally dramatic drops, characterizes the cryptocurrency market. Unlike stocks, which have a long history of development, cryptocurrencies have only been around for a relatively short time, making their performance more unpredictable and prone to sharp fluctuations. Comparing the historical performance of stocks and cryptocurrencies reveals significant differences. Stocks typically offer more stability and predictable growth over the long term, making them a more reliable investment choice for many. Cryptocurrencies, with their potential for high returns, come with higher risk and unpredictability. Understanding these performance trends is crucial for investors deciding where to place their money in 2024. Benefits and returns. In the world of investments, stocks and cryptocurrencies offer two very different paths. Stocks are known for their stability and predictability. They tend to provide steady growth and dividends, which are regular payments made to shareholders from a company's profits. Over time, many investors find that stocks offer a reliable source of income and value appreciation. Additionally, stocks are heavily regulated by government authorities, which adds a layer of protection for investors. These regulations help to ensure market integrity and provide a safeguard against fraudulent activities. On the other hand, cryptocurrencies present a more volatile but potentially lucrative option. They have shown remarkable growth potential, especially for those who invested early. The dramatic price increases of various cryptocurrencies have caught the attention of many investors. Investing in cryptocurrencies also means getting involved in cutting-edge technology, particularly blockchain. This technology is known for its security and transparency and is considered to have the potential to revolutionize various industries. However, the high growth potential comes with significant risk due to the inherent volatility of the cryptocurrency market. When it comes to deciding which offers better returns, it boils down to a comparison of risk and reward. Stocks generally provide steady, albeit moderate, returns with a lower risk profile. Cryptocurrencies, while offering the possibility of extraordinary gains, come with a higher level of risk. As 2024 approaches, the choice between these investment options will depend on individual financial goals and risk tolerance. Understanding the distinct advantages and drawbacks of each can guide investors in making informed decisions about their portfolios. Risk assessment and management. The financial landscape is filled with opportunities, but it also comes with its fair share of risks. Stocks, despite their reputation for stability, are not immune to market fluctuations. Economic conditions can cause significant swings in stock prices, influenced by factors such as economic downturns, company performance, and market sentiment. For those who invest in stocks, managing these risks often involves several strategies. Diversification is a key approach. Spreading investments across different sectors or asset classes can help reduce the impact of poor performance in any one area. Additionally, stop-loss orders can be used to automatically sell a stock when its price drops to a certain level, limiting potential losses. Long-term holding is another strategy that involves keeping investments over a longer period, allowing them to recover from short-term volatility. Cryptocurrencies, on the other hand, present their own set of risks. The extreme price volatility in this market can be startling, with values sometimes fluctuating dramatically within short periods. Furthermore, regulatory uncertainty adds another layer of risk. Different countries have varying regulations regarding cryptocurrencies, and these rules can change rapidly, impacting the market. To manage these risks, it is essential to only invest what one can afford to lose, given the high-risk nature of cryptocurrencies. Utilizing cold storage for digital assets, keeping them offline, can enhance security against hacks and theft. Also, choosing trusted and reputable platforms for trading can help avoid potential fraud and technical issues. Understanding and managing risks is crucial whether you are investing in stocks or cryptocurrencies. Each type of investment requires its own set of strategies to safeguard against potential losses while aiming for financial growth. As you consider your options for 2024, weighing these risks and implementing effective management strategies can help you navigate the complexities of the investment world. Future outlook and trends. As we look toward the future, the landscape of investing is on the brink of significant changes. One area to watch is the growing integration of blockchain technology into traditional finance. Blockchain, the technology behind cryptocurrencies, is finding its way into various financial services, offering more transparency and efficiency in transactions. This integration could reshape how we interact with money and financial systems. Regulatory changes are also on the horizon, with many governments considering new rules for both stocks and cryptocurrencies. These regulations could have a substantial impact on the market. For cryptocurrencies, stricter regulations might introduce more stability but could also limit some of the market's innovative aspects. On the other hand, regulations for traditional finance might focus on improving security and fairness, potentially affecting how stocks are traded and managed. Looking ahead to 2024 or 2025, market predictions vary but offer some intriguing possibilities. Experts suggest that cryptocurrencies may continue to grow, driven by technological advancements and increasing mainstream acceptance. However, they also caution about potential regulatory hurdles that could influence this growth. Meanwhile, the stock market is expected to remain relatively stable with steady growth patterns, but subject to global economic conditions. It seems both stocks and cryptocurrencies will play significant roles, each with its own set of opportunities and challenges. The decision on which to invest in will depend on individual risk tolerance, investment goals, and how these evolving trends align with personal strategies. Keeping an eye on technological advancements and regulatory developments will be crucial for making informed investment choices. Cryptocurrency and stocks each offer unique opportunities, but the future is still uncertain. As we head into 2024, will the volatility of crypto outshine the stability of stocks, or will traditional investments remain a safer bet? Share your predictions in the comments below. Don't forget to like this video, subscribe for more insights, and let us know what topics you want us to cover next.